Welcome to Talking Legal with Templars. My name is Dupe Dabiri, Managing Counsel in the Finance and M&A practice. With me is Ojuolape Kalesanwo, an Associate in the Finance and M&A practice. Today we'll be talking about warranties and indemnities insurance, with particular focus on the buy-side insurance policy. When a business is sold, the seller is required to give certain warranties in favor of the buyer. These are essentially factual statements that help the buyer flush out inconsistent information against the warranties provided by the seller. It also gives the buyer ground for a contractual claim in the event that any of these warranties prove to be untrue. And then there are also indemnities which offer, dollar for dollar protection where there's been loss suffered by the buyer for any, incorrect warranties. For indemnities, it will usually relate to a pre-identified set of circumstances. Ojuolape and I were discussing some transaction that we did a while back. It was an asset acquisition in the telecom space. Our client was the buyer on that transaction. It was their business entry into Nigeria, and they were dealing with a very interesting seller who, although had received certain notices from some regulator who was asserting jurisdiction over their business, didn't agree with that and has said to our client, the buyer, to essentially ignore those notices. So just to give more context to this, right? The regulator was Nigeria, which is, a regulator that looks over environmental matters. They were asserting that certain environmental audits were required to have been carried out by the target, which hadn't been carried out, and the target was being asked to comply. The regulator also, threatened some adverse actions on the business, and our client was quite nervous. We're worried that we would buy this business, and then following on from our acquisition, we are, in a tussle with the regulator, so to speak. So this led to very heavy negotiations of sort of like an indemnity package, which the seller was reluctant to give because they didn't agree with the regulator anyway. So that presented a huge risk that the buyer would ideally have wanted sufficient protection against.
On another transaction that we worked on, we were advising our clients, an investor in a midstream oil and gas company in Nigeria. This was our client, an offshore company's first entry into Nigeria as well. And this was following the recent enactment of the Petroleum Industry Act. And there was a bit of uncertainty regarding the applicable consent regime. The seller in this case was willing to provide warranties in respect of their position on the consent regime, but given that we were not necessarily aligned with their views on this, there was this risk that was still applicable regarding what would happen if later on in the future, following the acquisition, the consent regime position taken by the seller was found to be incorrect.
Yes, so I think that the risk that we just identified sort of presents an opportunity for the warranties and indemnities insurance being utilized in Nigeria. I mean, we see that the product may be gaining some traction. Do you want to tell us, what the warranties and indemnities insurance means?
So warranties and indemnities insurance is a specialized type of insurance product which allows the policyholder to make a claim in relation to a breach of a warranty or an indemnity claim arising from a purchase agreement. And there are two types of the warranties and indemnities insurance, the buy side or the sell side, and this speaks to which of the parties is actually taking out the policy.
Right. So for the sell side, how does it work? Could you describe the process, just to shed some light on that?
Yeah, so for the sell side insurance, the seller holds the policy, but in order to make a claim against that policy, the buyer must first make a claim against the seller arising from a breach of a warranty or enforcement of an indemnity from the underlying purchase agreement. And then the seller is able to have recourse to its insurer in respect of that claim.
How about the buy side?
So for the buy side policy, the buyer directly takes out this policy with the insurer, and where there is a breach of a warranty or the ability to enforce an indemnity, is able to go directly to its insurer to make claim under that insurance cover. It doesn't need to go through the seller.
I remember we were talking about warranties and indemnities insurance policies the other day, and we sort of noticed that the sell side, historically more common, but we've seen the buy side insurance policy gain more traction, right? And is increasingly becoming more popular. So for the buy side, can you walk us through some things to consider? Like if a buyer is looking to get the insurance policy, what are the things driving that?
Yeah, so some of the things that would make the buyer want to be the party to take out the insurance policy include where it doesn't want to have recourse to the seller. So like I mentioned, for the buy side policy, you wouldn't need to make a claim through the seller to enforce in respect of a breach of a warranty or an indemnity. Where the seller is of low financial standing, the buy side insurance policy would give you comfort that you would actually be able to receive monies where there's a breach of a warranty, unlike just having something on paper. Also, where there's a need to maintain a good relationship with the seller. So, for example, where the seller is going to remain involved in the target entity going forward, e.g. as part of the management.
That makes sense. And I think that in addition to that, if the buyer is willing to staple buy-side insurance policy for the warranties and indemnities, of course, to its bid, it potentially makes it more attractive to a seller. If the seller is looking at two competing bids, and there's one on the one hand which is a lower price but has stapled to it the insurance, and the other one, although a higher price, has no insurance policy, as a seller, I might be more attracted to the one with the policy because I don't want to be on the hook for a warranty claim or an indemnity claim for such a period of time. I want to just get my purchase price and then be off the hook, right? So that I think would also be sort of like a merit to
definitely
procuring that insurance policy. So there are other things that we should discuss, around premium, cover and period, just to give more, color to what the policy would entail for someone looking to procure it.
Yeah, so taking them one after the other. In relation to the premium, this would usually be between 1% to 3% of the total cover being provided, and then in practice we usually see an average of between 1.3 to 1.7%. There are many factors that determine what the premium payable will be. This includes the complexity of the transaction advisors, the level of due diligence done, and who bears that cost is subject to negotiation. So even though you might have a buy-side warranties and indemnities insurance policy, it doesn't mean that the premium cannot be commercially negotiated to be borne by the seller. And then in terms of the cover, you would usually see that being between 10 to 30% of the target's enterprise value. And then for the period of cover, again, this is one of the benefits of the warranties and indemnities insurance, particularly for the buy side. So just because you've negotiated certain time limitations in relation to your warranties and indemnities in your purchase agreement doesn't mean that with your insurer, you can't negotiate for longer periods. An extended period of time. So of course, you have to bear in mind the effect this might have on your premiums. And so we usually see between around 3 years for general warranties, and then 7 years for fundamental warranties, so warranties that touch on title, which is a very key one, and then also tax warranties and tax covenants.
Right, so quite apart from these things, what else is to be expected when procuring this policy?
I'll summarize this under 3 key points to bear in mind. So due diligence, the exclusions and your excess. So for due diligence, this would usually be a very important point to the insurer, so they would want to be involved in the due diligence process, because obviously this speaks to the state of the assets that you're acquiring or the company that you're acquiring, and you have to bear that in mind in terms of timing considerations as well. In terms of the excess, this is a commercial point regarding how much you would have to contribute to a claim before you can then actually receive monies from the insurer. And then exclusions. There are certain things that you typically find excluded from a warranties and indemnities insurance. So claims arising from the buyer's fraud, arising from a breach of sanctions, where you've had some corruption or bribery allegations, the insurance company would usually not want to bear responsibility for such. Where parties are thinking of utilizing warranties and indemnities insurance, they would need to ensure that this is taken into account right from the start of the transaction. So when you are negotiating your heads of terms, like I mentioned, insurers will usually want to be involved in the due diligence process. This affects things like the premium you end up paying. So you'd want to negotiate it right from the start alongside your transaction documents so that you don't cause delays to your transaction.
Excellent. Thank you very much. That was very insightful. I mean, we learned a lot about the intricacies, particularly, premium, the cover, as well as, exclusions, the DD process. I think it's important for parties at least to bear those in mind right off the bat, because it could affect timing, cost, which are very important factors for doing M&A transactions. Thank you very much once again. This has been Talking Legal with Templars. See you next time.